Welcome back to Factful Finance. Let me ask you a question. What do you think the difference is between index funds, mutual funds, and ETFs? Sure, they sound like they're in the same boat, but these three investment vehicles are more like distant cousins than identical twins. Let's break them down today in a way that makes perfect sense. No jargon, just actionable knowledge. Now, I know some of you might be thinking, aren't these all the same thing? I hear about them all the time, but which one is best for me? Well, you're not alone. In fact, a lot of investors, even seasoned ones, find themselves caught in the crossfire of this trio, not fully understanding when and why to use each. First, let's start with the basics. Index funds. These are essentially mutual funds that track a specific market index like the S&P 500. The goal? To match the performance of that index, nothing more, nothing less. What makes them stand out is their passive approach to investing. Instead of trying to beat the market, they aim to mirror it. Because of this, index funds generally have lower fees. But keep in mind, while the fees are lower, the returns are likely to follow the market's movements. No highs, no lows, just steady growth over time. Then we have mutual funds. These are actively managed funds where a team of professionals makes the investment decisions for you. They pick and choose which stocks, bonds, or other assets to invest in based on the fund's goals. Unlike index funds, the goal here is to outperform the market. But that comes with a higher price tag. Management fees can be significantly higher. And while these professionals have a vested interest in picking winners, there's no guarantee they'll beat the market. In fact, studies show that most mutual funds underperform their benchmark indexes over time. And finally, ETFs, exchange-traded funds. They're a bit of a hybrid between index funds and mutual funds. Like an index fund, many ETFs track an index, but unlike mutual funds, ETFs are traded on the stock exchange. This means they can be bought and sold throughout the trading day, just like stocks. ETFs generally have lower fees than mutual funds, and they give you more flexibility because of their intraday trading. They combine the best of both worlds, the diversity of a fund with the flexibility of trading stocks. So which one should you choose? Well, it depends on your goals and your appetite for risk. If you're in it for the long haul and just want to ride the market's ups and downs without worrying about it, index funds might be your go-to option. They're ideal for investors who want a set-it-and-forget-it approach. On the other hand, if you're looking to outperform the market and you're okay with paying higher fees for professional management, mutual funds could be worth considering. But remember, past performance isn't a guarantee of future returns. Don't just chase the hype. Check the fund's track record and see how it aligns with your risk tolerance. Lastly, if you want a mix of low fees, flexibility, and the ability to trade throughout the day, ETFs might be your perfect match. They're great for those who like to make moves and want to keep their options open. Just remember, while ETFs provide more flexibility, they might not have the same long-term growth potential as a well-managed mutual fund, especially in volatile markets. Now, let's look at Emma's story. Emma's been investing for a while, but is ready to take things to the next level. She's a long-term investor, so she loves the idea of index funds. But when she started looking at some ETFs that track niche markets, she realized she could get exposure to specific sectors she's passionate about, like tech and renewable energy. After doing some research, Emma decided to add a few ETFs to her portfolio for diversification. She still keeps her core investments in index funds, though, for the steady growth. That's how you blend stability with growth. Ultimately, whether you choose index funds, mutual funds, or ETFs depends on your financial goals, your risk tolerance, and your investment timeline. No one investment type is better than the other. It's all about what works best for you. And hey, if you're looking to dive deeper into the best strategies for each of these investment vehicles, hit that subscribe button and join me for more fact-filled finance breakdowns. As always, this content is for educational purposes only. I'm not recommending any specific products, so always consult with a certified financial professional before making any decisions. Which one resonates most with you? Drop your thoughts in the comments. I love hearing your perspectives. Want to keep leveling up your financial knowledge? click on the next video that'll take you even deeper into the world of investing. Trust me, you won't want to miss it.